Global economic growth has slowed this year, led mainly by weak manufacturing and business investment. In early October, we had another bout of volatility on global share markets. This was caused by surprising results in a key US manufacturing survey that indicated we're seeing the weakest conditions since the global financial crisis. It's tempting to get out of the market during volatile times, but should you? When markets fell during those first few days of October, sensationalist media headlines spoke of billions of dollars wiped out. It's difficult to ignore the media hype, and thinking about what might happen next can be worrying. Most of our clients choose to ride out the ups and downs, but those who do switch tell us that negative returns are the main trigger. Unfortunately, this can be costly. During the global financial crisis of 2008, the extended period of market volatility caused some clients to switch to more conservative options like cash. Now that may have initially felt reassuring as markets kept falling, but those clients locked in a loss of 8.5% on average at the time of switching. And here's the big red flag. Of those who switched to cash, not many switched back out, so they missed the rebound in markets, as well as the subsequent decade of sustained growth. To show how damaging this can be, let's look at Susan and Bob, a couple who retired just before the GFC. Between their retirement savings of $650,000 and their age pension entitlements, they're targeting an income of $65,000 a year. Now this is a pretty healthy balance to fund their retirement lifestyle. But if they had switched to cash during the GFC and not made the switch back, 12 years later, their balance would be $180,000 lower than if they'd remained invested in the balanced fund. After switching to cash, Susan and Bob would have experienced less volatility, but the returns would also have been much lower. As a result, they would need to lower their spending by 20% or risk running out of money at age 83. That's a whopping 10 years earlier than if they'd stuck to their financial plan. Now this is just one example based on our research of a typical client, and your situation may be different. History shows that clients who stay invested in growth assets and stick to their long-term plan end up better off than those who keep changing investment options. The good news is you don't need to worry about monitoring markets and managing your investment choices. We track the latest developments and adjust our portfolios within specified ranges to make the most of market conditions, all with the aim of maximising your long-term savings. Susan and Bob are an illustrative example only to demonstrate the key points, and we understand that everyone is different. If your situation has changed or you're feeling uneasy about the markets, be sure to speak to your financial planner.